Yields in the Treasury market are on the rise yet again. We have the yield on the 10-year note hitting a 14-month high. We're seeing stocks move slightly lower on the back of that. So let's talk about the relationship between interest rates and stocks with Tim Bray. He is a fund manager at GuideStone Capital Management. Thank you for joining us, Tim.
Yes, thank you for having me on the show.
So let's talk about this relationship, especially when it comes to what's going to happen with the private markets and what's going to happen with public markets. You know, a lot of the funding that happens that fuels stock market gains or gains period come from debt. So if interest rates are creeping higher, moving higher, what impact is that likely to have on both the private and public markets?
Excellent question. The first thing we have to ask ourselves is why are interest rates moving higher? I think it's a function of two things. One, it's a function of expected stronger growth, and that's a great thing. There's a lot of pent-up demand as economies reopen from COVID, and so that's a good influence moving rates higher. We're also seeing rates move higher because inflation expectations are moving higher as well. What does that mean for stocks? Well, stocks are impacted by higher interest rates because that's going to pressure valuations because you're discounting now at a higher rate. So I think that some of the volatility you're seeing in the stock market, some of the pullback is a result, a reflection of those higher interest rates.
And I'm wondering how much further does that have to run? Right now, we've been seeing this kind of trade where interest rates go up, people sell tech, they buy things like banks. How much more room does that have?
Excellent question. I think there's going to continue to be continued rotation out of growth into value. I think that's going to have some sustained momentum here. I think we see rates, if they approach the two and a quarter on the 10-year, it's going to put a lot more pressure on equities than we've seen thus far.
And is there subsectors in that value group that you like more than others? I mean, like today we got news that the consumer confidence is moving higher. We're seeing signs, you know, that consumers are feeling better. So, do you like the retail sector more than the banks, or do you like the banks more than retail, or are they all kind of like the same for you?
We actually really do like financials from here. We like the banks. Specifically, you saw some bank pressure as a result of the unwind of the hedge fund over the last couple of days. So a little bit of opportunity to buy some of the banks at cheaper prices. But we do think a steeper yield curve is going to be beneficial, and there's good opportunity in banks.
And I know that you see like there's a bit of you see it as a tug of war in the markets between the impact from the stimulus and higher spending versus the prospect of higher taxes and higher interest rates. So which is going to get the best of the market?
That's a great question. We feel like right now the market really hasn't priced in higher taxes. And so that's the next shoe to fall as we move on. There's a lot of optimism priced into the market. You mentioned consumer sentiment move higher. Everyone's talking about how growth this year could be, 6, 7, 8% and on real GDP, very strong growth numbers. But people are overlooking the fact that taxes are going to move higher, both on the corporate side and the personal side. We do think that's going to be a weigh on taxes as we approach later this year. But right now, the market seems to be focused on just the momentum and the higher growth, and has not yet focused on those taxes. Historically, a lot of times the market really doesn't react until it's more of a reality than forward-looking on a tax basis. But we think that that's going to come.
So I know investors like yourself don't wait for the market to really have that reality check, right? You guys like to move before the market to set that position so that you could benefit from it. So if you believe that higher taxes are inevitable, then what sectors are you starting to move into so that you could take advantage of whatever's going to happen?
That's a great question. I do think we want to be defensive from here, given the prospect for higher taxes and the impact on valuation. Earlier, you mentioned privates. We think there's incredible opportunity in the private markets that can avoid some of the noise and some of the volatility that we're going to see as a result of taxes coming down the line, and probably equity markets due for a sell-off. We haven't seen a sell-off or a 5% correction in over 4 months. So we expect more volatility there. We see opportunities in real assets specifically as a result of higher taxes. we continue to see, opportunity, as we already mentioned, in the banks as well.
All right, great. Thank you so much for joining us. That's Tim Bray. He's a fund manager at GuideStone Capital Management. I'm Conway G. Gittens, and this is Reuters.